Hi friends, welcome to A to Z Learning channel. Today in this video, we'll talk about RBI Retail Direct Gilt account. Yes, it's a new account that has been in the media that Prime Minister himself kind of launched it. So what is this all about? So in this video, we will help you understand what this account all about is, what are the benefits, and what are the key conclusions takeaway from this whole guilt account is so that you are well informed and you can make the right choice, right decision in terms of using this account as you look at or review your existing asset portfolio. So without any further delay, let's start our video. So as I said, this video is all about RBI Retail Direct Gilt account. So therefore, the first question that comes in our mind is, what is it? So what it is simply an IT platform which was recently launched by Prime Minister Mr. Narendra Modi along with the RBI governor. What it does, it's a platform which allows you as an investor to buy and sell government securities. Historically, until this account was launched, the only way for buying and selling government security was either by through the mutual fund or through your existing demat account, which allow you to kind of buy government security. So there was a third party involved. With this gilt account, the RBI, which is the issuer of these government security, you will have as a retail investor ability to purchase or sell those securities directly with RBI. So you basically cut down the intermediaries in this. This platform will also allow some of the other bonds like sovereign gold bond that RBI issues from time to time. So you will have the flexibility to use this account to buy those gold bond also, as against currently a lot of people use their banks or their existing demat account to purchase those sovereign gold bond which are issued by RBI from time to time. Okay, so hopefully the what it is makes sense. So it's simply an IT platform which allows you as a retail investor to directly buy or sell government securities that are issued or bonds that are issued by RBI. Okay, that takes us to the next question. What are the benefits of this? So let's talk about the benefits. First of all, the key benefit is that if you use this account to invest, to purchase the government bonds, government securities, the biggest benefit is that there is a sovereign guarantee on this bond. The sovereign guarantee basically means that there is absolutely no default risk. There is absolutely no risk of you losing money. Whereas when you kind of deposit your money in a fixed deposit or in a mutual fund or buy a corporate bond, there is always a risk for the bank to go belly up. Bank, like we saw, a lot of investors saw in the case of PMC Bank as well as in the Yes Bank, where they lost out some of the bonds, some of the kind of money that was um, invested by retail investor in them. With this, because it's a direct account with the RBI, there is a sovereign guarantee, which means there is absolutely no risk of default in which there is absolutely no risk of you losing the money. So that's the big benefit. Other benefit is that these accounts are absolutely free of cost. Opening these account is like opening a bank account, like opening a demat account. It's a very simple process, entirely digital. If you use Aadhaar and PAN card as a KYC, as long as you have a bank account and Aadhaar card and PAN card, you have no problem in terms of opening this digitally. There is absolutely no fee of account opening, and there is absolutely no fee for maintaining whatever bonds, whatever investment you're maintaining in this account. Of course, every time you'll purchase or sell, there will be some payment gateway fees which will be involved, but those are nominal charges. But account, like normal demat account that you maintain, you need to pay some charges for that. There is absolutely no such fee in the case of RBI Direct Gilt account. Okay. The other benefit is that if you are one of those investors who like to do it yourself, DIY investor, then this is great. You don't need to rely on a mutual fund to be making the choices for you in terms of which fund, which bond that they buy in their fund. In this, you can opt for, if you are looking to buy a 10-year maturity bond, then you can invest in a 10-year maturity bond. Or at the same time, if you're looking to kind of purchase something which is 30-year, 50-year maturity, you can choose whatever you like. So it gives you the full flexibility. So it's a direct investment option, which works really well for people who understand this area and who don't mind doing it themselves. Taxes, unfortunately, there's no special tax benefit here. So interest that you earn on these bond is taxed like your normal income. So it's clubbed with your normal income and taxed accordingly. It's similar to the taxes that you pay on fixed deposits interest. They are just added into your income, and then whatever is your tax due on the basis of your overall income, that's what you'll pay. But the other thing is that FDs don't increase in their value, whereas the government bonds, their value can go up or down based on what's happening in the interest rates. Usually when interest rates go down, the value of the bond goes up. So if you want to sell before the maturity in a falling interest rate environment, you can get better value, more value for the bond that you have invested in. So you could have some sort of gains also in this. But reverse is also true. If interest rates go up, then the bond value goes down. Therefore, you could have value less than what you paid for until maturity. At maturity, you will get whatever is the face value of the bond. You won't lose anything. But during maturity, because these are 10, 15, 20, 30, 50 years bond, maturity bond, most people don't hold it until maturity. They sell it before maturity. So they need to keep in mind that if you're trying to sell it in the environment when interest rates are going up, then the bond prices will be going down. Therefore, you may lose some of the money there. So any gain that you get on sovereign on government bonds at the time of selling, that gain is taxed at 10% as long as you have held that bond for at least 1 year. Whereas in the case of, say, fixed deposit, when you redeem, most of the time banks these days charge you a penalty, 1%, up to 1% of penalty. So if you have a deposit of, say, 10 lakh, you'll pay 1% of that, which is 10,000 rupees as a penalty charge. So you get less than what you have paid for, what you deposited in the FD case. Whereas in this case, depending on which environment you are selling it, you have the potential to have more than what you paid for. And that gain will also be subject to a lower tax of 10%. So there is that benefit, but normal interest that you get is taxed as per normal income tax rate. So there is no benefit there. Usually the interest is paid on the government security on a semi-annual or annual basis. So depending on the bond that you're buying, usually the government bonds carry a semi-annual interest. So every 6 months you will get the interest that bond that you have bought for. Interest rates could be like, for example, a 10-year government bond could give you an interest uh, yield to maturity of about 6.3% to all the way up to 6.9% for, say, 30-year bond. So it's definitely a higher interest rate than the fixed deposit. So having talked about the benefits, let's talk about the cons. What are the kind of downside of this? As I've talked about the interest rate risk that is there. Currently, a lot of people will say that interest rates are at rock bottom level. There's only one way, which is interest rates to go up. Therefore, there is a risk that the price that you will pay today, a year later or 2 years later, when interest rates are higher than the current level, you will have the value of your bond less than what you paid today. So you need to keep that in mind. Again, you need to be doing your own analysis to see what do you kind of forecast for the future. But if you're buying it for say 10, 15, 20, 30 years, then it may not be an issue, because you will go through these cycles of interest rates going up and then going down. So you can time your sell and purchase accordingly. But interest rate risk is absolutely there with these bonds. Other thing is the liquidity to trade in, especially the buy and sell, because it's a new platform. There are only few people who are available who will be doing the buying and selling the market. So liquidity will be low, especially when you compare it with the mutual fund, Gilt mutual fund, because Gilt mutual fund act as a counterparty, so they honor any request of redemption from their own pocket, whether there is a separate buyer or not. So there is more liquidity in the mutual fund. So if you're looking to kind of trade in and want to regularly have the flexibility to come out of these bonds, then probably this Gilt account is not your place. Mutual fund, Gilt mutual fund will be better option. So that takes us to the final part in terms of the key conclusion. So I feel that this Gilt account, a direct flexibility to own, buy and sell government bond, definitely has a place. Government bond definitely have a place in your asset portfolio, and the weightage of that will be as advised by to you by your financial advisor. Or if you make your own decision of investment, you need to kind of decide what portion you want to keep in the government bond. But definitely some part staying in government bond definitely makes sense. So therefore, your ability to fulfill that part of your portfolio by directly buying through this Gilt account makes perfect sense. And if I especially kind of look at the people who rely on the FD interest to pay for their regular expenses, people who are close to retirement, who are winding down in terms of coming out of equity and keeping their money in the FDs so that they get regular interest income to pay for their lifestyle expenses, I think for those people, um, government bond is definitely a very good option, because FDs still carry the default risk, because banks could kind of shut. Though government has always tried to kind of protect the money that is kept in the bank, but there is always going to be that risk. Plus, FD interest are lower than what you earn on the government bonds. And government bonds do come with absolutely no default risk, sovereign guarantee. So therefore, if you are one of those investors who keep large sum of money in FDs, you have no intention of cashing those FDs, but you run your show, you run your lifestyle based on the interest income that you earn on FD, you definitely need to consult your financial advisor to see whether some part of that FD should be replaced with government bond. And if the answer is yes, then this direct gilt account, RBI retail direct gilt account, could be a good option for you to purchase those bonds. So I hope this short video about RBI retail direct gilt account is helpful. We would look forward for your comments on this video. If you think we are doing a good job, then please press the like button, share this video with your friends and family members. And if you like the content that we produce on a regular basis on some of these concepts, then please subscribe to our channel A to Z Learning and become part of our viewers family. Thank you so much for watching our video, and we would look forward to your comments on this video. Thank you.